Our members come from the lowest income brackets in society. We are pensions with a purpose. It's not about me, it has to be about who's investing in our pension.
Which asset class maybe in the next 5 years you see getting more traction?
I think I probably will be biased.
Let's see how unbiased you are. What are the risks right now? What should we be wary of? What can we do to cover ourselves?
It's no longer timing the markets, it's the time in the markets. We're looking for the potholes. For us, it's all about avoiding the losses. We're not like equities. We don't see rainbows and unicorns everywhere.
Charlotte Vincent, co-head of fixed income at People's Partnership. Thank you very much for finding the time to spend with me this afternoon.
Thank you for having me.
In plain English, what is your job about?
My sole purpose of my job is to enhance the member outcomes by basically choosing the best fixed income portfolio for our members. So the People's Partnership is a UK master trust. So we've had about 36 billion assets under management with about 7 million members. And our members come from the lowest income brackets in society. And so the whole point of pensions is that they're long-term investments, but these people aren't necessarily financially savvy. They're probably not even checking up on their pension. So the fiduciary responsibility is completely on us to make best long-term decisions for these members, to give them the best possible returns possible. And for me, that's in my specialty is fixed income. And so it's choosing the best fixed income opportunities that would give them the right risk reward, so exposing them to the best yields that they can get without taking undue risk, which would jeopardize their income.
I will ask you at some point how you choose, but before that, you do have a very interesting path in your career. What I would like to know is how you got through at first in finance and what took you out of finance at some point and then back in.
I joined very traditionally through the graduate entries. So banking was a thing at university that other friends were into and were applying to and did internship. I turned up for the free wine because all the banks used to come up and have little free wine and canapes, and they'd give you a little talk. And actually, I liked the talk as well. So they got me by the wine brought me in, and I stayed for the career. So I did that. So I started off in emerging markets distressed debt before moving, in the investment banking world. I worked in syndications, loan syndications. And then from there, I moved into credit flow trading. So I was trading the syndicated loans, leveraged loans. I did that. I was very unoriginal. I never left the B's. I aspired to work for a company which was with the name of a C because I worked at Bank of America, Barclays Capital, Bear Stearns. So I was very much stuck in the B's until I decided to have a family. And whilst I loved credit flow trading and it was some of the things I absolutely enjoyed, it definitely doesn't go with having identical twin daughters. So I had to be in for 7 a.m. In my job, and actually that's just not possible. So I completely left finance. I retrained and became a teacher. So I taught physics and chemistry A level and a bit of actually IB as well, because I like to spice it up a bit.
Sure.
But so I did that for 10 years until my children were old enough. So when my youngest turned 6 and I could then return to a more full-time role, I then returned back to the city to a job I love. But I obviously moved from the investment banking side to now being completely the buy side. Well, not actually asset owner, really not even buy side, asset owner side. So now my job is to look at all these fixed income opportunities. I no longer have to make discount cash flow models. And in fact, if I did, I'd probably do it very slowly and not as well as I did when I was in my 20s.
What is the kind of change that you've seen jumping from one side to the other? If you want to add also literally getting out and in again as well, like the main differences, but mostly what I'm saying is really from the banks to the other side of the fence.
Yes, I suppose obviously investment banking, you're very much used to it. It's quite a fast-paced environment. It was far more short-termism. Like there might be a big strategy, but you're trading. You're more about your P&L, and that's more of an annual basis. Whereas obviously my current role, my time horizon is 10, 20 years. So I mean that's a completely different mindset. It's no longer timing the markets, it's the time in the markets for us, and that's quite a shift. But it's also quite freeing because it means that I can objectively, I'm no longer reviewing, just a trade, I'm reviewing a whole asset class. And it could be that I'm looking at CLOs. And it could be that I'm, and obviously CLOs as structured products, it's tranched up risk reward process, risk reward profile. And I could be reviewing that, and I could be reviewing that and do a lot of work on it and decide not for now, but it might be something I should go into in a couple of years' time. So there's no immediacy to it. So you can take that longer view. And actually, for someone like myself who always loves to learn and is very open to learning and very open to admitting my lack of knowledge in areas, it's an amazing job for constantly learning and growing and finding out about new things, rather than, investment banking, you were more in a niche, but it was fast moving
Yeah.
and day to day and rapid. Whereas now it's more of a long-term outlook.
Do you look at the asset class again overall, or do you have specialties that you focus on in terms of sector, vertical, industry, region?
So the way we've currently done it, so I have a co-head, and she very much focuses on the private market side, and I'm looking at the semi-liquid. We both look at the public markets because that's obviously the huge part of our portfolio. But within, let's say, that semi-liquid area that I look in, that credit opportunities, there's a huge range. So that could include leverage loans, it can include emerging markets. If we're doing soft currency, it can do the whole of the structured credit products, ABS, MBS, CLOs, distressed debt, special situations. And it's a great area to be in because those asset classes provide such different levers. So it means that I can view them objectively in a way of that, what do I need this asset class to do for me? Am I looking for a yield enhancing? Do I want downside protection? Am I wanting to have some floating rate to give me some interest rate protection? And they all have these different criteria that you therefore just have to work out what would enhance the portfolio the best for our members. And there's pointless going into, never going to go into an asset class for the sake of, I'm never going to see something and think, I don't have any of that, I should have something of that. So it has to be additive. But it does mean that you can review each one and decide which levers you want to pull, because in fixed income, we're very aware that, we're not like equities. We don't see rainbows and unicorns everywhere. We're looking for the potholes. For us, it's all about avoiding the losses. So we always have that very risk mindset.
Yeah.
We want to get what's best, but we need to know where the problems are. Where could it go wrong? When won't this work? When will this be a detriment? And therefore, we can make those decisions.
Let's look at the current market then. Where are the risks right now? What should we be wary of? What can we do to cover ourselves?
Well, yes, the market right now is actually quite a tricky place to be because spreads are at their absolute tights. Everything is priced to perfection. We haven't left ourselves a lot of space if things do start to go wrong. And it does always go wrong at one stage. And we don't think we're there now, but we've got to really carefully watch. And so for us, it's really looking into things like default rates, and understanding why my idea of default rate might be different to a different asset manager's idea of a default rate. Is having to understand what people mean when they're talking about default rates. Do they include loans that might suddenly pick as a default? Because if they're not paying the interest, that's kind of technically a default, but maybe not. And if they go into an LME, so liability management exercise, that they're like, at what stage, how are people marking that? How do people view those? Do they have the capabilities to deal with those scenarios? Do they have a workout group? Can they deal with restructurings? We have some due diligence questions, and they're about 5 pages long. When people send me back answers, they tend to run to 200 pages, and then they'll have attachments as well. So we go in depth here, but the main aspect we use is conversation. So with our asset managers, so we have a partnership. So our big fixed income partner is Invesco, and we talk to our fund managers every 2 weeks on every single tranche, on every single bit. We're having constant discussions. We have a portal which they very kindly designed with us and made for us, that we can every day look at the risk, look at our exposures, see every aspect of what we own, how we own it. And if I had a question, I wouldn't wait to have my meeting in 2 weeks' time. I would pick up the phone and we'll send an email saying, can you call me and talk me through this? But as us, I'm no longer at the coalface. I don't manage money directly. The managers completely run all our money for us. I have to trust them and I have to be able to ask them any question, and they're good. So if they don't know the exact answer, if I can ask quite long questions. They get back to me very quickly, and I have to trust that that's how it works. But yeah, there are things, when things are priced to perfection, there's not much room to maneuver, and it could go wrong.
And how do you see the comparison, going back to kind of the real world, between fixed income, equity, which asset class maybe in the next 5 years you see getting more traction, or do you see a rebalance towards one side or the other one?
Asking a fixed income person, I think I probably will be biased.
Let's see how unbiased you are.
Yeah,
The
so
academic.
yeah. Funny enough, I think in the shorter term view, there's the equity market doesn't look like it's going to roll over anytime soon. So there's still some room to grow in that. So if I was putting a short term bet, but for 5 years, I don't know how anyone's happy with that concentration. That would make me incredibly nervous as a long term. Diversification is the only free lunch. You need to be diversified. So we choose in equities to be diversified very, if we're looking at it across the global side. So obviously, whilst you might have the Mag 7, which is very, very concentrated, we're not, our exposure to the US is, I'm going to not the equity persons, but 50-60%, let's say. So you've still got quite a lot of other markets there that are doing quite a lot of other bits. There are different markets that sort of will be passively invested in. So things like the US market, actually passive investing, active investing doesn't seem to be that additive, whereas the passive investing seems to be the best way to enter that. But there are other smaller markets where actually maybe going active could be a better way to get it, where it's less efficient, where you have nuances. But no, yeah, the fixed income person in me says 5 years fixed income. I think it's going to be, we live in interesting times, which is that lovely Chinese curse, is that we're going to see inflation move around. We're going to see rates move around. We're obviously on a downward trajectory at the moment. How long will that remain on the downward trajectory? That kind of depends on what happens with that inflation figure. That growth figure looks good, but if we have a political environment where you can't raise rates, then we could get ourselves into a slightly hyperinflationary scenario that might mean that we need a bigger correction when people can raise rates. It would never be a popular thing to do, but so I think we definitely live in interesting times, and I definitely would think fixed income. We don't have such potential for upside. We're never going to be like the equities, but what we do is we monitor risk very well, and we're trying to prevent that downside, which for the retirement side, what we fear most and what we hate most are drawdowns, because if someone's about to retire in the next year and suddenly have a big drawdown, that affects their lifestyle. So for us, for me, the fixed income offers that downside protection, offers that extra risk, and it's got so many different aspects of it that you can, it's not longer, you don't just have to be playing in treasuries. You can, as I said, treasuries, you've got IG, you've got high yield, you've got emerging markets, you've got opportunistic, you've got structured credit products. Then you can even go to the private credit worlds, and that you've got a spectrum to choose from. So I think because it's more diverse on the long-term strategy, fixed income, but obviously biased.
Of course, fair enough. And again, going back to essentially the question, hey, how do we make money here essentially in the long run, right? What opportunities you see that maybe might be not obvious for non-extremely technical people?
So typically the structured credit product market was institutional investors. But actually ETFs now can give you exposure to those markets. So you're actually seeing quite a democratization of those markets that typically people couldn't play in. Actually now they can. Now it's far bigger in the States than it is over here, partly because of their nature they have their 401ks, and so people invest a lot more. But yes, I think there's probably some very interesting exposures you can now get for non-institutional investors using ETFs as a proxy. Um, CLO AAAs are very, they give you an enhanced yield over the investment grade, and yet they've got a zero default history. So that's probably very attractive to someone on the street. If they wanted to go more risky, that's when they should be playing probably more in that equity space if they're looking for that upside. But if you're looking for a long-term secured income with limited downside, then yeah, probably some of those ETF wrappers of the structured credits probably quite good.
And you also mentioned you work with third parties, right? Managers that
Yes.
manage money. Like, how do you select them? What is that matters for you?
Yeah. So we're not the easiest. Managers, we go through very rigorous processes to choose our managers. As I say, we've got huge due diligence questions. Um, what we actually look for is long-term partnerships. Um, we need someone who knows us, who wants to grow with us, who is basically an extension of our team even. So so I can refer to my current partnership with Invesco. So we deal with, not just only our fund managers, but the solutions team. So I might go and work with the solutions team and ask them to do some blue sky work, like what kind of assets could I put in? How could I model this out? Where is my efficient frontier if I add this asset class in? All fantastic questions, which very clever people from Invesco in their solutions team, and they will work with us and they'll come up with us and we say, well, what if we change this? And what if we up this into a certain, we want to do, we said 5%. What if we up to 20%? How does that change how it looks? So you've got to have somebody who, that you're not only just having that day to day, you've got that sort of, blue sky thinking, you've got the educational piece. I might go and say, I want to know about this asset class. I don't know enough about this asset class. I'm not saying to them, you're going to get to work on this asset class, but I'm saying to them, as your partner, can you educate me? Can you help me? Can you fill in a gap? So yeah, as I said, we're quite demanding. As I said, Invesco, they've built a whole new portal with us to
Nice.
do all our and that was over a 6-month project of working out what we wanted to see, how we wanted to see it, and them doing a lot of work to get that up and running. And now it's up and running, and it's all perfect, and it looks fantastic. But yeah, I definitely I'm not sure everyone would have been quite so keen to spend that much time with us. But we go through very rigorous process. Obviously, we're very big on the due diligence. We have to understand all their processes. I know a lot of people talk about track record, but unless your processes are sorted, then you won't have a good track record. So honestly, track record is often quite useful for showing it because it highlights when something didn't work, and then you can often go back saying, so why didn't it work? Where did it go wrong in that process? The other thing that we have to mention is the RI side. We are long-term investors. We therefore believe that ESG is a financial material risk, and we care about that. We have a net zero guideline, net zero target for ourselves. So we certainly have put that across our whole equities portfolio, and it's across all our investment grade and our fixed income. So we will be reducing our emissions. We have exclusion lists. We work very closely with our stewardship team at our partners who engage with issuers directly for us and on our behalf and on behalf of all their clients, but also occasionally on our behalf if we've said we really would like you to talk to these people because we've got a big investment with them. Could you explain what they're doing to make the world a better place, and how are they doing it?
Would you say your peers in the industry take ESG as serious as you guys do?
I would hope they want to. We do take it very seriously. Actually, my ESG team just won the PRI award in New York. Actually, sadly no one was there to pick it up, but they've sent it very kindly to us. But it is a huge focus for us. I think talking to most asset owners, yes, it is. You can't, everyone considers it financially material, and there's a backlash going on in the States, and that's more of a political thing. From what we understand from asset managers, whilst they might be taking ESG off websites, actually they haven't changed their processes. Their processes are still consistent. And the fact is we will always demand that they reach our standards, and we demand a best-in-class approach that if you can do, you have to realize different asset classes can do different parts. Obviously in Equities, they have lots of voting, not so in fixed income. Fixed income, we're just more about engaging.
Yeah.
So you have different aspects of different asset classes, but we want our managers to do the best for us that they possibly can in every single asset class.
Yeah, I mean, look, just a comment on this. There has been quite of a good growth in terms of green bonds as well, sustainable finance overall.
They sort of can ebb and flow in popularity, I think, and they're very good products. But I think often what we like to see is obviously the issuers at the whole, like just not those sustainability linked aspects. Is that we want everyone to be doing it across
Yeah.
all of it. But no, yes, I think those are great. But the funny thing about ESG is if it's successful, if the end result is good, in a few years, our ESG people don't want to be out of a job. They want it to be so embedded that it
Yeah.
doesn't need an additional name. It doesn't need additional questions on it because it just should be there, embedded fully. I think we all know that's a long way away. So they aren't talking themselves out of a job just yet. But yes, no. What we're hoping to do is we want to make this all not to be. This shouldn't be considered added extra. This should just be considered minimum requirements, what everyone needs.
Standard.
Yes.
Just a little game to finish. So I'm gonna fire you a couple of things. You choose one. Yeah, they can't choose both. So duration or credit?
Credit.
Active IG core or passive IG?
Ah, I'm active light. Yeah, I'm
Hmm.
buy and maintain. We sort of decided fully active, not necessarily, but not passive. So I'm kind of in
In
the
the
middle.
middle. Okay.
Sorry.
Public credit or private credit?
Ooh, tough. Public.
Okay. One last thing. If you want people to remember you for one thing in the industry or as a professional, what would that be?
Someone that improved member outcomes for the little people. Like we are pensions with a purpose. It's not about me. It has to be about who's investing our pension, which also happens to be me.
Fair enough.
But so it's
It is you.
slightly self-serving in a way. But obviously, I'm not. I'm quite a small part of that. But yes, yes, I think wanting to improve the outcomes of our members is probably the nicest aspect of our job.
Okay. Charlotte, thank you very much. It was very, very insightful. And thanks for finding the time.
Thank you so much for having me. It's really interesting.